For over 70 years, United States Treasury bonds have been considered the safest asset on Earth, the bedrock of global finance, the one thing every central bank, pension fund, and sovereign government agreed on. But right now, something is breaking. 5 major nations, China, Japan, Saudi Arabia, Brazil, and India, representing over 2 billion people and $15 trillion in combined GDP, are simultaneously selling United States government debt. In just the last 18 months, more than $400 billion in treasuries have been liquidated. Not by speculators, not by hedge funds, by sovereign nations. And when the biggest creditors on Earth start heading for the exit at the same time, you need to understand what comes next, because the consequences will reach your mortgage, your savings, your grocery bill, and the purchasing power of every dollar you hold. Welcome to the financial system. Control the money, control the history. And remember, simple is never easy. To understand why this matters, you first need to understand how the system was built. After the Second World War, the United States emerged as the world's undisputed economic power. The Bretton Woods Agreement of 1944 made the dollar the global reserve currency, tied to gold. Foreign governments trusted American debt because it was backed by something real. But in 1971, when Richard Nixon severed the dollar from gold, the backing changed. It was no longer metal, it was trust. And trust was reinforced in 1974 when Henry Kissinger struck a deal with Saudi Arabia. All oil would be priced in dollars, and in exchange, the United States would guarantee Saudi military protection. The petrodollar was born. Every country on Earth suddenly needed dollars to buy energy. Those dollars flowed back into treasury bonds. The United States could borrow without limit, run deficits without consequence, and print money that the whole world was forced to absorb. It was the most powerful financial arrangement in human history, and it held until the cracks became impossible to hide. Let's start with China. At its peak around 2013, China held nearly $1.3 trillion in US Treasuries. As of late 2025, that figure has fallen to roughly $760 billion. China has cut its holdings nearly in half over a decade, but this isn't panic selling, it's strategic repositioning. While reducing its exposure to American debt, China has been quietly accumulating gold at an extraordinary pace. The People's Bank of China officially reports around 2,300 tons, but independent analysts estimate the real figure could be far higher, possibly above 5,000 tons, purchased through state banks and offshore channels that don't appear in official disclosures. Central banks globally bought over 1,000 tons of gold in each of the last 3 years, the fastest accumulation pace since the end of the gold standard. China is leading that charge. And it's not just buying gold, it's building an alternative financial architecture. Bilateral currency agreements with Russia, Brazil, Saudi Arabia, and dozens of other nations. The CIPS payment system to compete with SWIFT. Yuan-denominated oil futures on the Shanghai International Energy Exchange. China isn't just selling treasuries, it's building a world where it doesn't need them anymore. Now Japan, the largest foreign holder of U.S. debt, with roughly $1.2 trillion in treasuries. Japan's situation is different from China's, but the financial pressure is converging on the same outcome. For decades, Japan's interest rates were pinned near zero, even negative. Japanese institutional investors, pension funds, life insurers, banks poured trillions into foreign bonds, especially American treasuries, because there was simply no yield at home. But that era is ending. In 2024, the Bank of Japan ended the world's last negative interest rate regime. By late 2025, the 10-year Japanese government bond yield surged past 1.8%, the highest since 2008. The 40-year JGB yield breached 4.2% for the first time in its history. Suddenly, Japanese institutions can earn real returns at home, without currency risk, without hedging costs. When a Japanese investor hedges a U.S. Treasury back to yen, the cost erases nearly all the yield advantage. The math is now pointing Japanese capital homeward, And when the largest single creditor of the United States starts bringing its money home, the tremors reach every bond market on Earth. Then there's Saudi Arabia, the kingdom that made the petrodollar possible. For 50 years, Saudi Arabia priced its oil exclusively in dollars and recycled its surplus into US Treasury bonds. But in June 2024, the 50-year petrodollar understanding reportedly expired without renewal. Saudi Arabia signaled it is now open to accepting payment for oil in yuan, euros, and other currencies. In 2023, Saudi Arabia and China completed their first yuan-denominated oil transaction. The kingdom joined the BRICS alliance and became a dialogue partner in the Shanghai Cooperation Organization. It entered China's mBridge digital payment project. Saudi Arabia isn't abandoning the dollar overnight. It still holds over $140 billion in treasuries, but it is hedging. It is diversifying. And when the very country that anchored the dollar's dominance starts shopping for alternatives, the signal is impossible to ignore. Brazil and India complete the picture. Brazil's treasury holdings fell from $229 billion in late 2024 to roughly $168 billion by late 2025, a 27% drop in 12 months. India reduced its holdings from $234 billion to approximately $186 billion in the same period, a 20% decline. Both nations are members of BRICS. Both have signed bilateral currency agreements that bypass the dollar. India has been among the most aggressive central bank gold buyers in recent years, adding over 70 tons in 2024 alone. Brazil has expanded trade settlement in local currencies with China, now its largest trading partner. The pattern is unmistakable. These are not isolated decisions. This is a coordinated, structural rotation away from dollar-denominated reserves and toward gold, local currencies, and alternative systems. So what happens when the buyers disappear? This is where the story stops being abstract and starts reaching your front door. The United States government currently carries over $36 trillion in national debt. It adds trillions more every year. To finance that debt, the Treasury must sell bonds constantly. When foreign demand is strong, borrowing costs stay low. But when major creditors reduce their holdings, the government must offer higher yields to attract new buyers. Higher yields mean higher interest rates. Higher interest rates mean more expensive mortgages, car loans, credit cards, and business lending. The housing market tightens. Corporate borrowing slows. Consumer spending contracts, and the debt itself becomes more expensive to service. The United States now spends more on interest payments than it does on national defense, over $1 trillion a year just to service existing debt. Every percentage point increase in yields adds hundreds of billions in annual cost. It is a mathematical spiral that no amount of political rhetoric can escape. And here's the deeper risk. When foreign buyers retreat, the Federal Reserve faces a grim choice: let yields rise and crush the economy, or step in as the buyer of last resort, creating money to purchase the government's own debt. That's the bond trick, America lending to itself with money conjured from nothing. It keeps the machine running, but the cost is inflation. Every dollar created dilutes the ones already in your pocket. Groceries cost more, rent climbs, wages lag behind. You run faster just to stay in the same place. Inflation is not a natural disaster. It is the price of keeping a debt-based system alive when trust erodes. History is not silent on what happens next. Britain once stood exactly where America stands today. The pound was the world's reserve currency. British bonds were the safest asset. The empire borrowed endlessly, confident that demand for sterling would never fade. Then came 2 world wars, mounting debts, and a slow drain of confidence. By 1956, during the Suez Crisis, the United States threatened to collapse the pound by dumping its holdings, and Britain surrendered, not to an army, but to its own debt. The transition from British to American financial dominance took decades to build, but the final collapse happened in a matter of days. That same pattern is forming now. The dollar's share of global foreign exchange reserves has fallen from 71% in 1999 to under 59% today. Gold's share of central bank reserves has surpassed the dollar's for the first time in decades. Over 40 countries have expressed interest in joining or partnering with BRICS. The infrastructure for a post-dollar world is being built in real time through currency swap lines, digital payment platforms, and commodity agreements settled outside the dollar system. This is not fear-driven speculation. It is a structural analysis of debt, reserve flows, and the mathematics of confidence. The system doesn't collapse because someone declares it broken. It fractures because the math stops working, because creditors lose faith, and because the cost of maintaining the illusion exceeds the cost of walking away. 5 nations are not dumping U.S. debt at the same time by coincidence. They are doing it because they have calculated that the risk of staying in exceeds the risk of getting out. The lesson for you is the same lesson history has taught every generation that lived through the decline of a dominant currency. The system will not warn you. It will not send a notice. It will simply adjust, and those who understood the signals will have positioned themselves outside the blast radius, while those who trusted the illusion will be left paying the bill. Real wealth is not paper promises or digits on a screen. It is assets, knowledge, and independence that survive when faith in the system cracks. History doesn't repeat, but it rhymes. And the rhyme between Britain then and America now grows louder every quarter. If this gave you a new perspective, hit subscribe. It's financial system, and history leaves clues. I show you where the money leads.